I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, good to be with you, and we've got an interesting world out there.
Did the markets react the way you thought they would to the election of Donald Trump?
Well, actually, it was fascinating because there was there was a coal stock index. The symbol was KOL, and it essentially had crashed down into January, February with the weak oil prices, and then recovered. It was great. It was all part of that rotation of that sort of stock up into, May, June, which was about right, corrected, and then it kept going up, and I kept looking at it, and I thought, well, what's in this thing? So it was mainly outside of U.S. stocks, and I thought, I wonder if it's signaling that a Trump win, and it was, and there were some actual U.S. coal stocks in there. But they really didn't jump up until 2 weeks before the election. So there was a little bit of discounting going there. But he represents a huge change, and we covered that last week. And in my mind, and historically, I would call it a very welcome change. The alternative, which would be even more intrusive and bullying governments and bureaucrats, so thank goodness. But his ideas of lower tax rates for corporations and for individuals is very sound, and the possible protectionism isn't so sound, but it would be good for U.S. manufacturing, which lost jobs to Canada and to Mexico on the NAFTA free trade agreement. But they were lost basically because the peso and the Canadian dollar fell, it got soft relative to the U.S., so putting U.S. at a disadvantage, and that part has to be changed. If it's a free trade agreement, which this one isn't, it was designed by bureaucrats for bureaucrats, and they kept the privilege of currency depreciation to keep the central bankers happy. So then the U.S. was at a disadvantage because the dollar went up. So, but if you want free trade, have free trade and peg all three currencies to par at the U.S., and then there's no cheating on the currency. So, but anyways, there are positive items in this change, and boom, they came into the markets very strongly, very suddenly. You had a terrific rally in copper when a seasonal weakness was possible. You had, and zinc was another one, so base metals jumped up, and but then you had some curiosities like the marijuana stocks all of a sudden became the darling of the day, and they soared to upside exhaustions and terrific signals. And then there was even one, this dry shipping company, DRYS, which has been in a long disaster since 2011, and but every once in a while it gets very oversold, and then massive short covering squeezes come in, and there was another one on this. So with these pop-up items, and that's not a bad description for them because suddenly they popped up, one could say it has some of the signs of it being a silly season, and often silly seasons are more likely to happen in April, May, and I remember one back in 1996 where the whole of the world had to buy Canadian penny gold mining stocks, mainly on the big Bre-X promotion, which stock ran up to $286 or something, and it was a fraud. But all of that peaked out in April, May, and there was all sorts of ancillary stocks that suddenly, in 2 weeks' time, went up by, tripled, that sort of stuff. So that's actually where the idea of the silly season came in. But here we are. Some of it's pretty short-lived, and maybe we can look over our shoulders at it in a few months and say, yeah, that was a silly season. But we've got the way to look at it is the Trump administration will be much more constructive for the economy and for the individual than anything in many decades. But it will be accomplished slowly. This will be fought by the establishment, and it'll take a while. In the meantime, you've got credit markets to look at, and you've had a rush to steepening of the yield curve, which has been, we figured that the initial phase of steepening would be helpful for the bank stocks, and it certainly has, except that, as I think part of the surprise of the election, the curve really steepened, and of course that popped the bank stocks up in the U.S. tremendously. There's also the prospect that very intrusive legislation called DoddFrank will be given the shove, which would be good. And so that, now all of that's in the market, so banks are way overbought now, and so one can look for a back off there. And what else? Oh yeah, metallurgical coal itself, or coking coal as they call it, was another one that popped up. Iron ore is another one. So it was, a number of items really got excited. So all of these became overdone, and so the good news that could come from the new administration is likely in the market, and we have to face many months, if not quarters, if not years, before the whole new economy and new plans and new government begins to become effective. So this then gets us back into credit market cycle stuff, and what's going to happen to credit spreads. I noticed that crude oil is a little weaker in here, and that's not very constructive for the overall world. So actually, speaking of worlds, we live in a very fascinating one, don't we, Jim?
Well, that's why we do shows like this. Can you maybe tell us what the DoddFrank Act is and why it would be a good idea to get rid of it? Yeah,
well, it was one of those things with the crash, the bubble that blew out in 2007, as we described at the time, had all the characteristics of a classic bubble, such as 1929, or the one before was 1873, where, man, everything's in there going. And then one of the things you get with a classic crash is that you have a whole lot of recriminatory legislation brought in. Like, we're so shocked by this crash, we're going to bring in stuff that prevents crashes. If it wasn't so disruptive, it would be amusing. So, for example, in the early 1930s, the whole of the establishment recognized that the crash and the depression was caused by the big bubble that preceded it. And so then you had the formation of the Securities and Exchange Commission, the SEC, which was designed to prevent a great bubble. And then also one of the promoters of politicians promoting the SEC said that it would put a cop at the corner of Wall and Broad Street. You know, this was the other part, was the malfeasance. So bubbles were prevented, and of course 2007 was a classic bubble. And the other one from the early 30s that was put in was the Glass-Steagall Act, which was to separate Wall Street banking from Main Street banking, which was a good idea. But then in the 90s, the financial mania, as it brewed up to the classic big boom in 2000, all of the commercial banks were into the game anyway. So then they got rid of Glass-Steagall off the books. But so with the crash and the Democrats in charge in 08, 09, they just had to do something. So the name of the bill was DoddFrank, and it was massively intrusive to, what would you expect? They were bad things from happening. And so it was retroactive and recriminatory legislation and intrusive. So with the Trump administration, they'll get that. And but who knows? Maybe the next step would be to bring in the division between Wall Street banks and Main Street banks. I can go along with that one. So, but at any rate, Dodd-Frank is intrusive, and getting rid of it would be constructive for the whole banking system. So now, as I said, this is now old news, and while not implemented, it is in the market. So where do we end up, Jim? Back to being cautious again.
We'll have more with Bob Hoye right after the break.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Bob Hoye. Bob, on Friday, the NASDAQ briefly reached a record high and then pulled back along with the rest of the U.S. equity markets. What's happening there?
Well, it seems to be a surge because you had the old type of stocks rallying, the Dow type of stocks rallying, and the NASDAQ actually sold off because of the tech side, and so it's sort of rebalancing, if you will, so some of the tech stocks have been going, but it's very volatile markets. Liquidity has been diminishing, essentially, particularly in the bond side, because the rates have been so absurdly low that who would seriously position for long term? Also, many of the banks were constrained from trading positions as much as they could. So really the bond markets are thin. You've had the European Central Bank buying the hell out of corporate bonds in Europe, which helped to narrow spreads around the world. And what we're looking at here was the spread market got trashed all to hell on the crash of crude oil down to last January, February, and I think the spread on the CCC rated bond got out to a little over 20%, and then it came into somewhere around 12%. But that was 3-4 weeks ago, and it was a huge narrowing of spreads, which indicates a party in that part of the credit market. And parties don't run forever, and this one now is, I would say it's trying to reverse. It's not doing any harm yet, but the next phase of spread widening would be concerning and would start to impair the markets. The other one we look at, of course, in the precious metals markets is the ratio between gold and silver. Just here, I'll bring it up. And in good times, the gold-silver ratio goes down. So it's sort of like the metallic credit spread, as we've been calling it. And then in anticipation of bad times, the gold-silver ratio goes up, and it's up quite smartly since, well, just after the election. So it had, with the prospect of good times, the gold-silver ratio went down. And with looking ahead here, yeah, it's up. It was, the last high was 73, and it reached 74 yesterday. So it's beginning to break out, and if this gold-silver ratio goes a little further, it would be saying that there's some problems ahead in the credit markets. Now, many of the people that follow gold and silver mainly follow it because, well, central bankers are bad and gold and silver are going to go up, but that central bankers are bad, and until they're reformed, they'll continue to be bad. But the action doesn't always favor gold and silver. So on this one, in November a year ago, we did a study, and it outlined what would be needed in the sector for a bottom of the end of the bear market and the start of a new bull market. And through into Christmas, we were getting those things. So that was then, we took that to be the end of the bear and the start of a bull. And as we all know now, the rally up until June was fabulous in the sector. And then it became overbought with a number of our indicators giving a warning. And so then in July, the advice was that it's been great, but a significant correction would follow. And the target was around 25% sell-off in the in the big gold stock indexes, and more than that has happened. But what we're looking for here now is that the sector would bottom somewhere in the next little while. And well, actually, then we go back to what we were using last year to call for the bottom. But we're staying with the view that we are in a cyclical bull market for the sector. It won't be driven by the price of gold or the price of silver in U.S. dollars soaring up. It'll be driven by more practical things, such as, are the gold miners making any money? And if the price of energy continues to decline relative to gold, then that improves their operating margins. So one wants to look at the gold stocks as a business and as an investment, and somewhere in the next little while would be the time to re-enter gold stock market. But I just don't see how one can make any money out of gold and silver in U.S. dollar terms, because one of the characteristics of a post-bubble contraction is that the senior currency, which is still the U.S. dollar, becomes chronically firm, and that's chronically firm against most commodities and most currencies for most of the time. So this is then now, in U.S. dollar terms, the U.S. dollar is trading at a new high. It's up to 101 now on the dollar index, and it required breaking above. Well, on this one, what we used is that the bottom in 2004, it set a sort of a trough bottom, and then when it broke above the 20-week exponential moving average, that was the breakout. And what was that, at 88 or something? And it did go to 100, and that was in last February. And it spent the time since correcting the excesses of that move. And here we are now. It was 2 weeks ago when it had been setting a trough at the 95, 96 level, and then broke above the 20-week EMA, and so that was a big plus. And then the other one would be getting above the 100 level, which it has done. Actually got to, the last high was 100.7, And yesterday I think we saw 100.9, and today it's at the 101. So this is a breakout, and for the gold bugs, the worst thing that can happen is a firmer U.S. dollar. But if you're in other currencies that may be falling relative to the U.S., and you're in gold, then you've got good insurance. But to try and make money in gold in U.S. dollars is a bit of a mug's game. So,
Bob, thank you so much for chatting with us.
Jim, it's good to be with you, and we look forward to next week.
My guest has been Bob Hoye, market historian and chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for Bob can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.